Welcome back to the Energy Forum, a podcast from the Center for Energy Studies at Rice University's Baker Institute for Public Policy. I'm Ken Medlock, Senior Director of the Center for Energy Studies. In this episode, we're turning our attention to the global oil market at a time of shifting supply and demand dynamics. OPEC Plus is raising production while demand is facing some headwinds due to global economic uncertainty, and inventories are building in some places while shrinking in others. These developments raise important questions about what's ahead for prices, production, and global trade. To help make sense of it all, we're joined by two CES non-resident fellows, Abhi Rajendran, Director of Oil Markets Research at Energy Intelligence, and Skip York, Energy Economist and Industry Strategist. We'll also touch on this topic at our upcoming Energy Summit, Resilience and Energy Supply Chains. Abhi, Skip, take it away.
Thanks, Ken. Skip, it's as always, it's great to have you for this conversation. We've been talking about quite a few things over the last couple of editions of this podcast series, and with a lot going on in the oil market, from supply side dynamics, geopolitics to demand and inventory dynamics. So let's dive into what we're focused on as we kind of round out the summer, and we are kind of looking ahead to the next couple of months to round out the year, but also importantly next month at our Energy Summit. Some of the kind of the key data points that we'll be looking out for, and some of the tea leaves that we'll be looking to read. So I think maybe a good place to start, kind of a recent development, the latest iteration of the OPEC Plus meeting, and the kind of the slower supply increase planned for October, but nonetheless another supply increase. Skip, what do you make of what OPEC Plus is doing here? How to think about strategy rounding out the year and looking to next year?
I'll start by saying I was a bit surprised by seeing that they announced another production increase. I thought they would sort of hold where they were through the low part of the winter demand season, and then kind of see where how the global market was shaping up as we entered the northern hemisphere spring and get to March or April, and then they would start resuming capacity releases. That said, it was a small capacity release, so I think what they were kind of signaling is a couple of things. Market share is still an important issue to them, and so they're continuing to pursue that objective of trying to claw market share back from non-OPEC. And the other part of it is I think they were also sort of reacting to, they've released a lot of capacity into the market since the spring, not really a massive price response. So as long as the market's is soft but not collapsing, why not just keep pushing those barrels into the market? So I think they're just going to keep plodding along. It'll be interesting to see what they continue to do through the rest of the northern hemisphere's winter and then getting back into the spring. But if you kind of step back at over the last year or so, given sort of a demand environment that hasn't been the strongest, it's been okay, but not a really strong year. OPEC Plus has probably played the hand it's been dealt about as well as it could play it, while still maintaining sort of a relatively, I don't think market prices would be dramatically different if OPEC had taken a different path than it had taken. And so I'm kind of curious to see how they manage the winter months and what that might tell us about where they're thinking beyond 2026. How they enter 2026, is that going to send us some signals about how OPEC Plus is thinking about positioning itself in the market in 2027 and beyond?
Yeah, I think those are all really really important points. I mean, I would just quickly add that I myself, I wasn't too surprised about having a kind of a token increase thrown out there at the last meeting. We've been kind of tracking OPEC Plus supply over the last close to 6 months since they started the tapering process. And while headline they supposedly are planning to increase supply by 2.5 million barrels a day, including the adjustment to UAE. The reality has been, and of course September is not quite over yet, but the reality is that we're probably looking at something that's closer to like just two-thirds of that actually hitting the market. And so I think, I think they're already lagging. I think the increase for October is modest. But I think they kind of wanted to continue with the message that they want to continue to increase supply. I think there's, some geopolitical and, other strategic reasons for doing so, and that they, wanted to kind of keep the message out there. I think a couple of the important things to keep in mind also are there's a, visit ahead from the Crown Prince, Mohammed bin Salman, in November, to Washington. Of course, Trump is, very focused on energy prices, and inflation, and the Fed, over the next couple of months. So I think, that also kind of, at the side, potentially played into it. I think the one other thing is, you mentioned, yeah, prices have been, relatively steady, relatively calm. Back when we did an edition of this in June, of course, we were focused on geopolitics and, the potential for, risk and threats of supply impacting the oil price. We haven't really seen much of that lately. What do you make of that?
I think the market is increasingly comfortable with the global supply chain. I think it looks at the Middle East, and you know we had that yesterday. We had that Israeli strike in Doha. Seems to be a targeted strike, a one-off. Doesn't seem to be some sort of systemic escalation in tensions. But nonetheless, if you think back 10 years ago, this would have been a very big deal in the oil markets. And oil price Brent went up a little bit on Tuesday, went up a little bit. It's up a little bit more here on Wednesday morning, but not big reactions. And I think part of that is going towards this notion that the market, from a global supply chain, the market is more comfortable with the resilience. And I'll just come back and say this is, a shameless plug for the energy summit that's coming up next month, which the theme is resilience in energy supply chains. And I think the lack of response, both what was a rather muted price response during the Israeli-Iran conflict in June, and once again, yesterday just being another example, the muted response in the market on a price basis kind of tells you about the resilience in the oil supply chain that has developed over the last decade. And that's not just, it's just the infrastructure that's been built. It's supply nodes that appear like Guyana and the US and Canada production, and Brazil production levels are much higher now than they were a decade ago. So we've got more sources of supply. We've got more destinations, but we've also got more logistics connecting those sources of supply to those destinations. So when things like these events happen in the Middle East, the market absorbs them much easier now than they would have 10 years ago.
Yeah, no, I think that's right. And I think, as we have seen, or, from even just earlier this summer, but also more consistently over the last couple of years, the market has kind of learned that, to your point, the market is resilient. There's a lot of supply out there, and for now, there's just not, any kind of major cause for worry, or the potential for any impact on the supply side. So I think we, in our June edition of the podcast, we spent half of the time talking about geopolitics, but for now, there's not much to talk about, so we can kind of move on to fundamentals, which I think are, are kind of the key here. So maybe coming back to that, I mean, to the point that you made earlier, that oil prices have held up pretty consistently in the 60s, maybe low 60s for WTI, mid to high 60s for Brent, but it's been pretty steady, despite OPEC Plus actions over the last couple of months, OPEC Plus announcements over the last couple of months. It's been pretty steady. So I guess, what's your take on, kind of the underlying demand picture? And of course, seasonality and other things factor in, but what do you make of, just kind of where consumption stands, and also maybe more broadly, how, the broader macroeconomic backdrop has influenced it?
Yeah, I think I'll start with the macro. I'll start with the economic view, and then kind of come into demand. I think we were much more. I think that and when I say we, I really kind of look a lot at the IMF and the World Bank. There was a lot of concern early in the spring that Trump's tariff trade policy was inducing a lot of uncertainty, not only into the US economy, but to the global economy. And there was a lot of downgrading of economic growth. And we got halfway through the year. Now we're more than halfway through the year. And while the economy has grown slower than the IMF expected, say December of 2024, looking at calendar year 25, it hasn't slowed nearly as much as people feared it would in the spring of 2025. So if you've got stronger economic growth than you anticipated, that's a big driver towards the next link in the chain, which is that oil demand growth hasn't been as weak as we feared it would be. Now, it hasn't been we've been spoiled with big increases in demand in 21 and 22 and 23 as we were recovering from COVID. But that COVID recovery has now happened largely. I think jet is still a little bit behind where it was pre-COVID, but that COVID recovery has largely happened. So now we're back to the, what is the demand for oil, sort of contemporaneous demand for oil, not having to deal with recovering from a pandemic. And that market looks to be like it's not quite growing as fast as it was historically, but I think it's turning out to be a little bit stronger than we thought it was going to be. So demand really in 2025, I think, has turned out to be kind of in a bit of a way, sort of a non-story. It wasn't as weak as we thought it was going to be. And so it's absorbed, demand is out there growing, and it's growing in the emerging world, which is where we kind of thought that's where the growth would be. So we the forecast of it is getting that part right. And I think that as we're looking forward already, people are looking forward into 26. I think people see a little bit stronger growth in 26 than they saw in 25. But once again, it's not going to be a big step out in growth. And now that's going to bring us over to the supply side of saying, well, how do you manage bringing barrels of supply into that market if you're not going to have this tremendous pop in demand growth that we'd seen in 22, 23?
Yeah, I think that's right, Skip. I think that's a good way to put it. Many forecasts, both economic and as it pertains to oil demand, have kind of come off the ledge, from a couple of months ago when everyone was fearing a big slowdown economically, a big hit to consumption and things like that. Most of that has actually not happened. Yes, I think there are still risks. I think there has definitely been an impact to global trade, and there's been some rejiggering and reorientation, and I think there are things to watch for sure as we round out 2025 and look to 2026. But yeah, I mean, I think the way you put it, that the global economy is kind of churning along. There are haves and have-nots, as there always are, and oil consumption is also kind of plugging ahead. And I think we'll probably on track to sort of end up. So I think somewhere, ballpark around 1 million barrels a day of demand growth this year. Maybe it's a little bit shy of that, but as you also pointed out, I mean, if you are a little bit shy of that, if you have had some, kind of a negative impact for this year, then you could actually see maybe a little bit of a pickup, a little bit of an acceleration for 2026. To your point, I think you're probably in the zone of about 1 million barrels a day per year of growth, right? Both for this year and next year. I don't think, as you pointed out, there's not really any pent-up demand left. And I think it's going to be pretty hard, especially with the slowdown in Chinese consumption growth, just kind of core consumption growth. We'll talk about inventories in a sec. That it's probably not going to accelerate suddenly, even looking to next year. So numbers like 1.5 million or higher of growth for next year seem like they may be a little bit far-fetched for now. So as you pointed out, I mean, I think on the supply side, we are probably looking at the supply side needing to match somewhere around 1 million barrels a day of annual demand growth, at least for the time being. But one other thing I think that's again been part of the support for oil prices over the last couple of months and kind of held prices in the 60s range is inventory dynamics. So maybe you can talk a little bit about what we've seen there. over the course of this year, and I'll chime in as well, and also how that might impact next year too.
Yeah, so I think there's really kind of been it's like a tale of two cities when we talk about inventory. So let's split it into crude inventories and product inventories. On the crude side, we are seeing an inventory build. It's predominantly in China, where historically, when we're in an inventory build globally, historically about 40% of that build goes into OECD tanks. And in this current inventory build, we're seeing about 25% of the inventory build is going into OECD tanks. And the difference is being made up in China. And we're seeing those barrels and a lot more inventory going into China. And China's still building storage capacity. So they're sitting, if you look at their most recent numbers available, it looks like Chinese crude oil storage capacity looks like it's about 70%. So there's still room for them to build more storage or to take in more barrels if they wanted to. And there's always a security of supply part of the equation for China. And if you're in sort of this moderate oil price environment of the 60s, now is actually a good time to be building strategic reserves like Chinese inventory. Now would be a good time to actually be rebuilding the strategic oil reserve, petroleum reserve for the US, although Congress didn't allocate money to do that. But so we've got this build on the crude side. On the product side, we're seeing destocking. Now, there was a lot of destocking coming out of COVID, once again, like through 22, 23, and 24. But we're in 25, we're still seeing destocking going on, both in the OECD and sort of in China, because those are the two places where we get our best inventory data, both on the crude and the product side. So while we're building inventories on the crude side, we're draining inventories on the product side. And that explains in part why refining margins have held up in 2025. Refining margins have been a bit stronger, a bit firmer than people expected. And that's part of it, is that, we've got the moderate crude prices, but we've also got tightening product prices because we've got this destocking of product inventories. Net, it's a net build in petroleum, in liquid inventory, because we're building crude stocks faster than we're destocking on the product side. But we do have room for it. And that was something I actually just saw yesterday in social media, where somebody was worried that, we're about to fill the tanks, we're about to top the tanks and oil prices are going to collapse into the 30s, and this another one of these doomsday scenarios. But wherever I can find capacity utilization data, I don't see any, there might be individual tanks that are getting full, but as a market like China's at 70%, the US is, 70% or less. It looks like Europe is sort of in the upper 60s or low 70s. So there's still space to put barrels. So I'm not worried about an inventory fill all of a sudden being a snap on prices and us all of a sudden getting this big retreat because there's no place to put these excess barrels. To your point, if demand isn't going to chew up the barrels, we need to put them in storage, but it looks like we still have capacity to do that.
Yeah, no, I
So
think that's right. Yeah, no, I totally agree with you. The capacity is out there. I think it's going to maybe come down to, the inclination to continue to add to storage, right? Especially in China, which has been kind of soaking up quite a few excess barrels this year, and potentially, next year, if oil remains below 70, potentially dips below 60. I think they'll be more than willing to do so. But I think, I think that inventory. Look, yeah, to your point, I mean, whenever there's a market imbalance, the excess to the supply side, the excess supply has to go somewhere, and there is space for that supply to go. Yes, that may mean, kind of a slippage in prices. Yes, that may mean some downside risk to prices to kind of, rebalance the market, but there's definitely room for that crude to go, and then that'll be, kind of an adjustment process for the market. I do think that,
well,
yeah,
Abhi,
go
let me
ahead.
just jump in really quick and say it's not only the opportunity, there's also a need to build these stocks. I mean, if you look at US root stocks, they're near the bottom end of the 5-year average. So building crude stocks is not necessarily a sign of a market that's failing, like oversupplying. Like we are at the low, there are stocks that are at the low end of the supply range. And were you to get some sort of supply disruption, and it doesn't have to be geopolitical, were you to run into some sort of weather event or some other event where you ran, you know, some markets are near the bottom end of their storage range. They should be putting some barrels into storage, and they have an opportunity in this price environment and then this supply demand environment. They have an opportunity to restock those inventories, and they're doing that.
Yeah, no, I think that's right. And that dynamic will be, kind of interesting to follow for sure. I do think, just from like a price perspective, I think, the one last thing I would flag is we talked about OPEC, we talked about demand, we talked about inventories, but I think non-OPEC plus supply is another one that needs to be watched. My belief is that it's not adjusting fast enough to potential imbalances in the market, which are not going to be as big as some of the kind of forecasts that have been put out there are. We're not going to have 3 million barrel a day oversupply or more, but even a modest oversupply will need to be accounted for by non-OPEC plus supply, by U.S. supply, by America's supply more broadly, both North America and Latin America. So I think that's going to be another dynamic to watch, and we may, and I think we may actually need a little bit more price softness to kind of affect that change and that adjustment. I think prices kind of hanging in the mid to high 60s for Brent maybe are not making that adjustment fast enough. So I think that's another kind of interesting thing to throw out there. I think just one last one for you. We have an important event that we are hosting at the Baker Institute in early October with our Energy Summit. What are some of the, kind of the key things that you're going to be looking out for, some of the key data points, conversations that you think are worth flagging right now?
Yeah, so this year's summit, the theme of this year's summit is going to be resilience in energy supply chains. And so across the summit, we're going to be looking at a complex set of the trade-offs that you make in shaping the energy future between innovation, economic growth, and how you develop global energy supply chains that are resilient and responsive to those dynamics. And so you dial back into the podcast we talk about, we dial back into the oil world. And what I'm thinking about and hopefully we're going to draw it out in some of the panels at the summit is thinking about those very issues sort of in the context of oil. So I'm thinking about, it would be great to have some discussion around what technology innovations do we see happening in the upstream that's going to make production more efficient or that would potentially lower break evens. To your point, Abhi, that doesn't help when you're in a soft price environment. It doesn't help. That's not going to deter non-OPEC projects get more competitive as upstream innovation improves. So what innovations do we see are happening there, and how big could they be? I think there's also the demand side innovations, the alternative fuels, electric vehicles, hydrogen, ammonia for marine transport, demand side management, like things just getting more efficient. What innovations do we see there? And then I'd really like to see if we can get a discussion started on the middle, in the middle around refining, so that as that demand barrel, as we're bringing out these oil barrels, whether they're coming from OPEC or non-OPEC supply sources, but that demand barrel is changing. How does the refinery have to change in order to keep that market balance, in order to take that barrel of crude oil and convert it into the suite of products that the world's going to need as that suite of project changes over time? What sort of technological innovations are people looking at, or what innovations are going to be needed, and what might it take to trigger those innovations? I think we're not going to answer any of those questions in a 2-day summit, but really would like to start those conversations going, because I think there's a lot of really good thinking that's going to have to happen, and the Baker Institute wants to be right in the middle of being thought partners in that.
Yeah, I think those are all going to be really interesting things to watch out for, and I'm very much looking forward to attending. All right, Skip. Well, thanks so much for joining today, and we will be back more with. I'm sure it'll be a lot of interesting takeaways from the summit and from the conversations that we have around it. But for now, thanks again for joining.
Thank you for tuning in to the Energy Forum. Subscribe and follow our podcast and the Center for Energy Studies for more expert insights on global energy trends. This episode was produced by Maram Hajazi. AV production was led by Kevin Young. Until next time, I'm Ken Medlock.